Perfect, perfect. I just noticed we had over 120 registrants for our webinar, which is actually a record. We usually get around 100 or so. This was well above that. We currently have, at current count, about 65 people in the presentation right now. So we're really happy to have everybody. And we'll get going right now. So number one, thank you for everybody taking the time to come to the presentation, to learn a little bit more about where we are in the Opportunity Zone initiative, but also what does the future look like for Opportunity Zones. We're going to discuss USG and our unique platform, and then we've got an expert, Michael Hubert, who's the founder of the Hubert Group and Oz Fund Hub, who will be speaking to us on where Opportunity Zones are now, the current benefits, what the timelines look like, and on potential future legislation to expand Opportunity Zones. And then we have my business partner, one of my business partners, Andrew Spellman, who's head of construction and development for USG, where we'll dive a little bit deeper into some of our current projects and available equity. So with that, I'm going to start the presentation, and I want to thank everybody for being here. My name is Greg Genovese. I'm the CEO of USG Realty Capital. We're actually based on the West Coast with the main headquarters in the Seattle, Washington area, capital equity raising market office in Santa Barbara, California, and then satellite offices mostly around the West Coast. And we're happy to say that we're now on to our fourth fund, and currently about $285 million of Opportunity Zone assets that are currently under management. Before I begin, I do need to figure out how to put the slide forward. Why isn't that working, David? There we are. Before we get going, this is not an offer to sell. This is a 506C Reg D offering presentation, and everything we do through what's called a managing broker dealer. So all of our information's on file with FINRA and the SEC. These are the normal disclaimers regarding risk before we do any sort of presentation. So just like anything, if you do have an interest in our program or in Opportunity Zones and reach out to us, we'll then give you information more specific to your potential choice in a little bit more detail. But just know there's always risk investing in real estate or any investment whatsoever. And then I want to introduce our panel today. A lot of you, I see a lot of same names, know who I am. I'm the head of USG Realty Capital. We came into being in really this iteration back in 2018. We're now on to our fourth Opportunity Zone fund. Our first fund was actually named the top fund in the country by both Globe Street and Real Asset Advisor. And then we took that dynamic and grew it into USG Realty Capital, which we'll talk a little bit about in a few minutes. But also today with us, we have Mr. Michael Hubert. Michael is the co-founder of Oz Fund Hub and the head of the Hubert Group, which is a top-of-the-line, best-in-class digital marketing and marketing automation group. And then I'll just let Michael tell you just 10 seconds about himself right now. Go ahead, Michael.
Hey everyone, Michael Hubert here. As Greg said, co-founder of OZ Fund Hub, which is an educational resource for Opportunity Zones. We've also developed a product which is basically an Expedia for Opportunity Zones, which allows investors to go in there, enter their search criteria, and discover the Opportunity Zones that exist. I've been in the Opportunity Zone space since 2018, so I'm a bit of a veteran now. And my agency, the Hubert Group, which is a revenue marketing agency, focuses on helping OZs raise capital or find high net worth individuals. And the combination of the two companies that I own allows us to see a lot of data on the back end on the investor behavioral data and the OZ market data as a whole.
And if anybody happens to have an interest in looking at Michael's website, where they do focus on helping people with criteria and looking at the funds that might fit their criteria, you could either go to their website at ozfundhub.com, or you could just put your camera up to that QRF and it'll take you to them. And Michael will be around today, so more time to talk to him. And then my business partner, head of director of development and construction, Mr. Andrew Spellman, who put himself away from the screen. There he is. Andrew, just a short history on yourself, please.
Yeah, background, did 15 years as a general contractor, transitioned into the development world. I'm now working for USG, heading up development and construction oversight.
Great. And we'll dig a little deeper into what you're doing in a little bit. As I mentioned about QRF code for Michael, and by the way, panelists, unless you're speaking, you can go ahead and stop your video so that we only have one person on at a time. We know how valuable your time is. We also know that there are times you have interest, but you can't hang in there for the full hour. On the bottom right-hand corner of all of our slides, you'll see a QRF that'll take you directly to our website. And there you could fill out a submission form if you have any interest in talking to us and digging a little deeper. So that's what the QRF code looks like. You'll find it on every slide. So if at any time you need to beg out, but still have interest or whatever the case may be, please go to our website and we'll follow up with you. You can also ask questions there. Little housekeeping. If you go to our website, you have interest, just fill out an interest submission form. It's right there on our website, right at the bottom of the page. It's easy to fill out, goes right to one of our Opportunity Zone experts, and they'll read it, probably give it to me to look at as well, and then we'll get back to you ASAP. If you do have questions that you want to ask or chats during the Zoom, there is a Q&A and a chat button on your Zoom. Feel free to ask any question. We'll make sure. And if you do go on there and you see a question that you wanted to ask, just go ahead and double up on it. You can, there's a button there for you to enhance that question so that it's more likely to get answered. If we don't get to your question, we will be taking all the questions and chats and replying to them after the presentation. But if you want to talk during the time, then there'll also be a Q&A session at the end of the presentation opened up for the audience. We will be recording the webinar and you'll have access, and how you get access is through our USG website. And we also have a dedicated USG YouTube page as well, so you can see the presentations there. Usually takes a few hours to get it up on those sites, but no later than tomorrow morning. And our goal here, I want to make everybody know, this isn't just a pitch for our products. We really want to bring good value on where the market is. We're all about asset allocation, proper oversight and accountability, and risk mitigation, and we hope we can prove that up to you today. But at the end of the day, we want you to be educated and to help you make the best informed decisions in the environment that we're in today. So our agenda, real quickly, we're going to introduce you to USG. Michael's going to talk about the state of the Oz industry, some basics on where we are in the timeline and Opportunity Zone investing. I'm going to talk a little bit about, is it the right time to be involved in Opportunity Zone investments? And then I'm going to speak about our approach and why we believe our approach is unique and, quite frankly, the safest approach out there for Opportunity Zone investments. And then myself and Andrew will talk about our current available equity that we have in the fund at this time, and then we'll open it up for Q&A. Just a little bit of background on USG ourselves. As I like to say in 2 words, experience and track record. Myself, my partners have been in the industry for a long period of time. I'm now 34 years in the real estate asset management investment business. Started in 1989 with Bear Stearns, if anybody remembers them. So I've been doing this a long time, but collectively we have well over 100 years of experience in real estate development and asset management. Collectively, a little over $2 billion in investment equity, with over $5 billion rather in assets acquired over the last 30 years. And as I mentioned before, this iteration with USG is currently close to 300 million with 10 assets under management. And we have seen our share of awards and accolades. We believe we're getting these because we're doing it right, because of our unique approach. But we were named the top fund in the country, as I mentioned, Real Asset Advisor, Globe Street. We've been named a key influencer in the Opportunity Zone world with Real Estate Forum. Great. I belong to the New York Times Seyfarth Shaw Roundtable on Opportunity Zones, which reports directly to the President's Council, both the Trump Council originally and Biden's Council now, with good write-ups in Forbes. And so we're very appreciative of us getting these accolades, which really validates our process. So we want to thank not only our investors for the equity and the trust they've put in us, but also these publications and data folks who are recognizing that we're doing it right. Real quick on our track record, I won't spend a lot of time, but just want to show you some pretty pictures of things we've done. Our first deal was right there in Bremerton, Washington, Marina Square, $140 million project, $50 million in equity. This was named the top fund in the country by Globe Street. Market Flats in Olympia. Both of these projects are done and completed and open and leasing currently. And then Peyton Lofts in the state of Washington, which is one of our newer projects, and we're now accepting applications for those. And then fully subscribed deal in Hillsboro, Oregon. This was done through our partner, Aussie. It's called the Aussie Group. 9th in Washington, fully subscribed. This is our assisted care facility, fully built and leased in record time. Actually, we were ahead of schedule. This is in the Investors Choice Oz Fund. This was our first project. It was built ahead of time, a little under budget, and we're open for leasing and it's fully subscribed at this point. But that's a great asset, and we'll look to put more assisted care into the portfolio in the near future. Wisconsin, this is called Elevation 1659. I'll dig into this a little deeper in the presentation. This is a project that we're building with the largest full-service real estate firm in the state of Wisconsin, the Ogden Group. Good people. It's right across the street from their main headquarters. And this is being built now. And we do have a very small amount of investment left for this. We'll talk about that in a little bit. One of our newer projects, this is in North Dakota, Avery Apartments out of North Dakota. And we're partnering with the gentleman who's running for president, the governor, Doug Burgum. He owns this company, Kilborn. And so we've got the whole state of North Dakota and the city of Fargo really behind this project. And we're seeing a lot of investment equity starting to go to this project. So looking at it all, currently 82 million in assets that we're managing, 10 assets all the way from open and leasing to some are pre-opening. One, Elevation is still under construction, and 2, that'll be starting in the next few months. With that, that's just a little bit on our track record and what we expect. With that, I'd like to invite Michael Hubert of the Hubert Group to come back in and let you know what's going on in the Oz world today. Go ahead, Michael. Thank you for being here too.
Thanks for having me, Greg. Appreciate it. Yeah, so as I mentioned before, I just have a deep understanding of, the OZ market due to the businesses that I'm co-founders with. So let's jump into this and let's get started. We're going to go over to the OZ timeline and benefits, the opportunity zone investing update, and then the regulatory update. So here's just a brief history about opportunity zones. It was introduced in 2015. It didn't get exciting until 2017, and that's when it was passed through the Trump administration and the Tax Cuts and Jobs Act. And then in 2018, that's when I got involved. That's where you can see it really got exciting and everybody began to come in. The IRS released the regs a little bit late, and that's why there's a proposal to extend it. And then you'll see where we're at the current moment. So there's a current race to continue to build, continue to raise capital, and improve the Opportunity Zone program. The data is supporting that it's working, and people are super excited about it. And that's why investors are attracted to it, and also obviously the U.S. government. Next slide, please, Greg. So what I'd like to distinguish is 2 things, right? So there's opportunity zones, and then there's opportunity funds, or QOFs, qualified opportunity funds. So the opportunity zone itself is a low-income community census tract, and it's in need of economic revitalization. So these are a lot of communities that didn't bounce back from the 2008 issue. And so these were drawn up the 2010 census tract, and this is still in place. So if you can think about that, there are definitely some exceptional zones that exist. But with the Extension Act that I'll talk about in the next couple of slides are going to explain how they're going to redraw those tracts. A QOF, or a Qualified Opportunity Fund, this is an investment vehicle, right? And so this is the vehicle within that geolocation that basically is either a Qualified Opportunity Zone business or a Qualified Opportunity Zone property as far as commercial real estate goes. Next slide, please, Greg. So here's how the structure works. So if you look on the left here, right, there's the Qualified Opportunity Zone investors, and this could be a corporate investor or an individual, or we call them retail. And basically what needs to happen is a capital gain occurs. Once that capital gain occurs, there's a 180-day window, and this capital needs to be placed into a Qualified Opportunity Fund. So you see how that sits in the middle. Now, to the right of that, you'll see two possible scenarios that can occur here. That's the qualified opportunity zone business, or the qualified opportunity zone business property, which is on the commercial real estate side. A lot of opportunity zone, a lot of opportunity zone with real estate. There was a lot of opportunity zone. Sorry, let me rewind that. With commercial real estate, it qualified very easily, right? So what we've seen is a majority on the commercial real estate side. The qualified business side is still trying to get traction, but we believe with the census, not with the Extension Act, we'll see some traction on the actual business side. Next slide, please. So here's a couple of mechanics that exist. So the tax benefits on the left, right? So you're going to have your deferral, and that will go out to 2026, the end of 2026, so December 31. So if you experience a capital gain right now, you're able to defer that to the end of 2026. The basis step up, which has actually been removed, but hopefully being brought back with the Extension Act, will basically allow you to eliminate some of those capital gains taxes or just take a little bit of the burden. It started at 15%, then went to 10, then went to 5, but hoping to bring that back with the Extension Act. The tax-free growth, this is what attracts investors the most. So at the end of the 10-year hold, you're able to walk away tax-free from a federal standpoint. And the beauty with commercial real estate is there's no depreciation recapture. So on the right, we'll see the timing, right? As I said, the 2026 is the deadline, so December 31, that's how you can defer it. And then as far as the liquidation process goes, all properties must be liquidated by 2047. The 180-day window is very important. So after that gain occurs, you have a window, and this is very similar to a 1031. You need to make sure that you make that investment into a qualified opportunity fund within the 180 days. Now, there's 3 unique triggers with this 180-day clock on the gains. So the date of the gain, right, can occur, and then you have 180 days after that. If it's an LLC, for example, it could be the end of the calendar year. So let's say you sold an LLC this year, your clock won't start ticking until Jan 1. And then there's the K1 due date of the following calendar year on March 15th. Next slide, please. So the tax benefits of the Opportunity Zone funds, so there's 2, right? The temporary deferral, this is very beneficial, right? If you're looking to buy some time for yourself, you can defer those capital gains. And then the permanent exclusion is what really attracts everyone, right? So with that hold for 10 years, you can walk out tax-free from a federal standpoint on any capital gains. So let's say you invest, you invest and you hold it for 10 years in that commercial real estate, and let's say you pull out a 3.2 multiple, you're going to walk out tax-free. In some states, they do conform to the Opportunity Zone program, but be conscious of that. For example, California does not. So just take a look and be conscious of what state you're investing in, or what state you live in. I mean, pardon my French. Next slide, please. So the tax incentive timeline, what we have here, as you can see, and this is a great example. So looking if the OZ investment start date is in 2022, you can see you have that length of the deferment, the deferral period. So that'll go to the end of 2026. Then in April 2027, you're going to have to pay those deferred, that deferral. Now, the sweet spot is at the end, right? So in 2032, this is when liquidation can occur, and you can walk out tax-free from a federal standpoint. Next slide, please.
Yep. Well, actually, before you get off of that, I just want to make one quick point, if I could find my video. Okay, so one quick point. If I were to boil this down for investors and wealth advisors, due diligence officers, a lot of them already know. But if I were to look at this timeline, and we do have this approved for you if you want to get a copy of this, but basically the idea is, and something Michael's going to bring up, is the Opportunity Zone Extension Act, which will most likely put a lot of the nice benefits that people saw at the very beginning of opportunity zones, a 10 or 15% discount in your capital gains tax. And so Michael will explain that, but there's still the real power of opportunity zones. And that's what this timeline, I believe, shows is you invested in 22 in this example, but you've used 100% of your money for 22, for 23, for 24, for 25, for 26. Okay. And then what happens is you owe your taxes in 27. A lot of these companies, including us, are looking to refi in the year 2026, so you have plenty of money to pay your taxes in 27. So the deferral of not having to pay taxes using 100% of your money for the next 4 to 5 years is very, very strong, and you're not paying taxes on it. But the real juice, or the real the real exciting part about opportunity zone investing is the bottom line. Tax deferral on the initial investment, and then you combine that with 100% tax elimination at the end of 10 years. That's the real power of opportunity zones. It's the 10 years of tax eliminated gain at the end of the 10th year. I just wanted to make that point. Michael, do you want me to move on?
Yeah. Next slide, please.
Okay, if I can find the button. Here you go, sir.
So this is where we're at today, right? So there's an investment velocity that remains high. And so even though we did see a little bit of a dip in the market last year, we're still seeing that continued trend up and to the right. So it's starting at the beginning, you can see how it began to gain some momentum, and then it sort of went through, there was a big spike there. And then through 2020, a lot of people were taking, these capital gains from the stock market. So it was a higher volume, lower capital gain size. And then this went through until 2022, and then that's where we slightly see it flatten out. But what we're seeing on our end and on the backside of things is there's been less basically volume of capital gains, but higher amounts, right? And so this new investor persona is looking for, basically crafting solutions for diversification, which is extremely important. So we're not seeing these smaller $100,000 gains or $50,000 gains. We're seeing more on the upper side of that, so 900,000 plus, and that's what we've seen the average, in 2023. So with that being said, these investors are looking for diversification, and any platform or vehicle that can help with that is ideal to them. Now, the improvements on the horizon, what we're seeing is the government is we're catching their attention, right, with the opportunity zones. They're looking at this and seeing the impact that it's having, and that's why they're looking to, perform things like, better reporting, and then obviously extending it. Next slide, please. And so the Opportunity Zones Transparency Extension and Improvement Act is exactly that, right? So this was reintroduced in 2023. It is a bipartisan bill, and there's some key provisions here, right? So this is extending it to 2028, which is going to allow another 2 years. And the reason they're doing this is because the IRS took a while to get the regulations in place, and they're also bringing up the step up in basis. So that's going to be coming back, and it's also going to be retroactive. But with that being said, it's appealing to the investors, right? But then it's also, creating a little more scrutiny upon the funds, which is beneficial, right? We want more data, we want more reporting, we want to see the actual impact that it's having. So they're proposing those additional requirements, and then they're going to be sunsetting some of the other zones. So as I mentioned, it was drawn off the 2010 census tract. So they're going to obviously use the 2020 for that, and then sunset some of the zones for that. And then the last one is the OZ fund of funds, right? So this is allowing basically a fund to invest into multiple funds, which is very exciting. But the overall takeaway from this is the government, or basically the US government it's captured their attention, right? They are excited about it. The amount of capital that's being deployed into these zones and into these funds is very exciting. And they want to continue, or my takeaway or my perspective of this is that they want to continue this program. So it has that impact, and it's appealing to the investor and also to the communities. And so, like I like to say about opportunity zones, it's great for the investor, but it's even better for the community.
Yeah. And if I can, I want to dovetail a little bit just from my perspective to the audience, because these are mostly investors, wealth advisors, due diligence officers, asset managers themselves. And we've been in this from the start, just like you have, Michael, and following the original Extension Act that was put into Congress last year, but didn't get through. Just so everybody knows that there's an Extension Act that has just been initiated into Congress. At the end of the year, anything that was on the table gets tossed out and has to be reintroduced. So that's why it's been reintroduced. It's actually called HR Bill 5761. HR Bill 5761. We have it. If anybody should want to see what that looks like, we will be happy to send it to you. So HR Bill 5761, or just say, hey, send me that extension bill that's just been proposed to Congress. But at the end of the day, politics are always going to be politics, and we've got a lot of it going on right now. But the bottom line is when opportunity zones first hit, it was very bipartisan. And was pushed through Congress and everybody was excited, but Congress people don't want to jump on things with both feet and really plant their flag until they see that it's working. And that's why they've seen it now working, and they're saying, this is good. We need to extend this. And so in all likelihood, this period's going to get pushed out to 2028 or 2029 for those who are already invested. That just brings your deferral date out even farther. It'll be a wonderful thing. None of our funds none of our projects are in trouble. I shouldn't say trouble. They're not in line to be disqualified anymore, meaning early sunset. So we're fine on that. We've had that checked out. So we wouldn't apply to us. And we're all about increasing reporting standards because that's the way we've always done it from the very start. So I think you're starting to see opportunity zones catch on, and the government sounds like they're going to do the right thing and push out the date, but it's not there yet. Lastly, I will be at the Novogradac conference in Washington, D.C. on November 1st, and they're the top data and stats group for opportunity zones, including CPA and accounting. And so that'll be in D.C. on November 1st, and I will be reporting back in a blog what I hear as far as where that Extension Act is. Thank you very much, Michael. I appreciate it. And Michael will be back for Q&A after. Now I'm just going to take just 5-10 minutes to talk about, is it the right time? What does the environment look like right now? What makes us a little different and why it matches with the environment? And then a little bit about our fund. So looking at post-COVID, this is one of my favorite slides, not because it's great news, but it's a good slide to give you real information. You look at where we are right now, we have historic highs for property prices. We had a real high about a year and a half ago. And even with interest rates going up, you're seeing a rush for properties right now. And so you're seeing prices going up. And so, of course, that's greater investment risk, return risk, meaning you buy something high, gets a little bit of a gain, you're only going to see a small return. So there's definitely the ability to have higher returns buying into the market now, generally speaking, unless you get good pricing and good financing, is less and less. We really are at the end of the real estate cycle with greater bubble risk. We've all seen that. The stock market has been very peripatetic over the last couple of years. We saw a high in the stock market in the Dow in January of 2022. We're starting to see greater and greater market risk. The vast majority of opportunity zone investment money that came in at the beginning of the initiative was really people selling stock in 2018, 2019, early 2020. And then it moved to more bigger assets, people selling buildings, people selling properties. And then the amount of stock being sold, taking capital gains, kind of weaned off a little bit. It's still there and still strong, but the majority were people selling businesses, etc. Now we're starting to see it coming back to people selling stock or highly appreciated assets that have a little bit more connectivity or linkage to the way the economy is going right now. And so we're seeing a lot of people moving toward hard assets. Obviously, there's a greater interest rate risk right now in our country. We've had a 3.7% increase just this year on top of the past 2 years. So really, is it inflation or is it a recession or both? From our perspective, and being asset managers, being product managers, being product sponsors, we look at it as we don't want to have to play the game as, are we in inflation or recession? We look at it as if we really are now. That's the safest way to do this. And that means getting in your risk modeling, getting in the financing, getting your costs under control. Because at the end of the day, having money in hard assets, and you're seeing all kinds of gold commercials right now, there's a huge push, a huge wave toward hard assets. Combine that with the tax benefits you're getting from opportunity zones. If it's the right fund, it's the right sponsor, it's the right project, now is the right time to go into opportunity zones. And I think inflation is here, and there's much more greater uncertainty, and we're seeing a move towards tax advantage hard assets. Just to give you a visual, just look at interest rates from 2013 to 2020, 0.8, 2.1, 2.3. 21, we saw 7%. 22, we saw 6.5%, and so far 3.7%. so far this year. And it looks like, it's probably going to stay there or maybe up a little bit, maybe down a little bit. But you can't pretend we didn't have high inflation these last 3 years. And so what projects you're looking at, what's the financing? How is the company getting to their pro forma returns? How safely can you get there? In our opinion, is the key element to proper opportunity zone investing. And we believe we have a platform that actually facilitates that, which is why we're seeing much more equity coming our way these days. So the Oz solution is to capture and rebalance, harvest those capital gains that you may have, rebalance the portfolio to combat the risks associated with inflation and the recessionary pressure, meaning looking at hard assets that go with the values going up with inflation and even with interest rates. It's all about how you get the financing. And we're seeing a hard push towards hard assets, and then maximizing your tax advantages with the investment, deferral and eliminate gains, maybe with an opportunity zone fund or even a 1031 exchange. These are really the two best initiatives I see in the marketplace today. And knowing all of that and where we are today, we came up with an approach in 2019 that we really believe is to the best benefit of the investor, is to the best benefit of our development partners, and best benefit to the overall returns. And that is the top 3 points that are made there: risk mitigation, oversight and accountability, conservative pro forma, and maybe the fourth, alignment with our investors. Those are our top 4 tenets, meaning everything that we do, the fund itself, the projects itself goes through strict risk mitigation modeling. Well, what does that mean? That means everything from negotiating with our developer partners to make sure the budgets are in line and that they're taking on any cost overruns. That's also working with our developer partners to make sure that we're building things on time, and we also have the finance in place. We will not bring a project out to our investor group unless we have the projects fully permitted, ready to go, and the construction financing in place. And in most of our deals, we'll have construction and the perm financing in place already. And then a strong oversight and accountability metric, meaning USG as the oversight group, i.e. the asset manager for each one of our investors. That's why we co-partner with our developers, so that our investors know that we are on their side when it comes to managing the asset for best return. And then looking at conservative pro formas, this gets a little bit deeper, and this is why I encourage you to go to our website or reach out to us personally so we can go deeper into these areas of how do we risk model, how do we do oversight and accountability, what do you mean by conservative pro forma? And then the other point is we align ourselves fully on the side of the investor when it comes to our own economics. There is a model where we'll make a little bit of money from the developer side, but the vast majority of our returns, and we'll show you where we make our money, we have an approved piece to show that to you, is our alignment strictly with the investor. So our emphasis has to be on what's good for us has to be good for you. So we align ourselves with our investors. We set high preferred returns because that puts the onus on us, because we get back your return before we can share. And then we wanted to give people multiple choices, different projects within the same fund that they can choose from. And by doing that, we can go into smaller infill projects that can get built quicker, they can get financing a lot better, they get to the refi a lot quicker. That means the returns come to our investors quicker, they can get leased up quicker, and cash flow to our investors quicker as well. And this helps maximize the value. So our fund structure is the only one out there that allows for this smaller infill type of dynamic. And I'll talk to you about an infill project and what that means in a few minutes. Allows us to work directly with local and regional developer partners that actually have the expertise in this area, in meaning the physical area of Milwaukee, Bristol, Connecticut, Bremerton, Spokane, Fargo, and so on. And then lastly, we want to honor the spirit and intent of the initiative, which is to do good by these communities, but also do well by the communities, but do good by our investors as well. And so we do not only a tax opinion, but a full social impact report on each one of our projects as well. So that's what makes ours a little bit unique. And we took all of that and developed a fund called the Investors Choice Oz Fund. and it allows investors to really have as much project concentration as they want. You can go into one particular project in the same fund, or you can go into 3, 4, or 5 different projects in the same fund. So you have multiple projects, as much diversification or concentration as you want. We're not binded in by a certain demographic. We look for the best demographics that facilitate all that we've talked about before. That could be in Bristol, Connecticut. It could be in Houston, Texas. It could be in Denver, Colorado. It could be in Milwaukee. It could be in Fargo. And so we look for those dynamics, because at the end of the day, it's about holding on to your investment. It's about making it as safe as possible and getting the best return. And as I like to say, who owns it at the end is as important as who owns it at the beginning. And we want to make sure that the people that own it at the beginning own it at the back end as well. And then we focus on recession resilient asset classes. A little bit about our dynamic and going into infill. What does infill mean? Infill is areas that were either underutilized at one time, or they were developed at one time and are now coming back. So, i.e., a limited space to build. The reason that's important is I'm going to show you an example. This is just a sample. This is the overview of our Milwaukee project that we're partnering with Ogden and Company in Milwaukee. You can see the site and you see the area, and we call that infill because it's a limited amount of building that we can do in that particular area. So the first thing we do is we look at nationally at all the different income tracks, and we want to find the opportunity zones out there with better than average population growth, better than average for the area and in the US, better than average income growth, better than average home value growth. Well, what we found in Milwaukee and the other areas is Milwaukee, for example, income track 113 has the highest housing value growth rate in the city and county of Milwaukee, has the highest income increase over the last 10 years at 10% a year for the Milwaukee area, and has the highest growth in housing valuations and job creation as well. So we looked at that, and then we said, where could we go? And we found this great partner in Ogden, literally across the street from their headquarters. My partner, Andrew, will talk a little bit about this, but the reason infill is so important, guys, and the reason I'm hanging on it is the value of the project at the back end is actually of paramount importance, because when you're in an infill project, we now have 10 years from now, we're going to have to compete with projects that are maybe younger than us. And so if you're in a wide sprawling area, there's a good chance you'll have a lot of new product available in 10 years, which means the amount of money we would have to put into our project to keep the value at its highest rate could be a big number. And that's why we like to stay with infill, because it limits the amount of CapEx or capital expenditure we might have to put into this project to facilitate the very best value for our investors. It's the safest way to go. It's risk mitigated. And that's why we chose to go down that path. So when you look at our fund, what we did is we took what we felt was really the best of all 3 types of funds out there. The blind pool, which doesn't let you see what you're buying. The multi-project deal which lets you see what you're buying, but you have no choice. You have to go into everything. And then what's best about a single project is you can do due diligence, you can do your tax opinion, you can get all of these things done on a single project. And then we put it into a multi-fund dynamic. And it's the only fund that actually does this. So we're really taking the best of the 3 types of funds that are out there now and created a 4th type of fund. And what really is exciting about this type of program is you can look at our available investments right now. Kind Care, 11% preferred return. We're way ahead of schedule and fully subscribed. Elevation 1659 multifamily in Milwaukee at a 12% preferred return. We have just a little bit of equity that just got turned back to us that we're gonna sell to the marketplace, but fully baked and under construction right now. You've got Avery Apartments in Fargo, North Dakota. We just started this project, 10% preferred return to our investors. And Peyton Lofts in Spokane, Washington, 96 units right downtown, 10% preferred return. So an investor can actually go to our platform, and these are sample portfolios. Investor A puts $1 million in, spreads it out like this, a little bit in Milwaukee, a little bit in Bristol, a little bit in Spokane. Investor B has 400,000, puts across the board in all 4. Investor C has $100,000, puts it into Fargo and Spokane. And then this group, 2.5 million, split it between Milwaukee, Bristol, and Spokane. What's really cool about this scenario for our investors is at the bottom, you'll see that it's just one K1. All of our K1s are sent out no later than March 1st of every year. We're always out in front of you getting your taxes done, so you don't have to file an extension. If it's your choice to file an extension, that's fine. But we get out our K1s on March 1st. So this all comes on one K1, multiple projects, one fund, one K1. And then the way our returns work is we have high pref returns of 10 to 12%, depending on the project, $50,000 minimum to invest. And then our return at the back end, 100% of all the cash and all the returns go to our investors until we actually hit that pref return. So let's say it's 12% as it is in elevation. We would have to give our investors all their money back, plus their without the commissions, of course, if you do it through a wealth advisor, but all your money back, your return of capital, plus your 10 or your 12%. And then whatever the next bucket is after that, we'll split with you 80-20, but we don't claw back into the first bucket. It's 100% to you until we hit that pref return. And then whatever's left over, we split 80-20 with our investors. And we'll dig into this a little bit deeper. At this point, I hope that I was able to communicate what our approach is, how the fund works, and some of the dynamics that we hope you would like, including the risk mitigating modeling as well. With that, I'm now going to turn it over to Andrew Spellman to talk a little bit about the nuts and bolts in project oversight and development updates on our current projects.
Andrew? Thank you, Greg. Nice to meet you all virtually. I noted before, but a little bit about, a little more on my background. I spent 15 years with one of the largest GCs in the Seattle area. My primary focus during that time was high-rise multifamily and large healthcare projects. Transitioning over to the development world, I've overseen approximately 1,500 units at varying stages, from design, permitting, and entitlement to completing construction. My focus at USG primarily is oversight and accountability. And how do we do that? That really starts with our due diligence right out of the gate, all the way through construction completion. I bed myself into the team all the way from contracting with the GC, making sure the contracts are adequate, the costing is up to date, and then I follow that progression all the way through until keys are in hand, construction is done. The beauty of this is that it allows us to convey project info to all the investors in almost a real-time fashion. And we're able to answer any questions about the projects on the fly. If you've got a question, you reach out to me, we can answer it. We know projects are happening. Next slide, please. Greg touched on Kind Care. We were just out there 2 weeks ago, saw it firsthand, beautiful building. Residents are happy, and they're currently outpacing their leasing schedule, which is great to hear. And I'll touch on the details of the next ones in the following slides.
So let me just jump in here on elevation 1659. As I mentioned before, we have a small amount of equity left to bring into this project. So there is a little bit of this available right now. We have a construction and perm financing already in place right now at 4.5%. So like I said at the beginning, it all comes down to the financing you're getting in place and the price you're buying it, and keeping your costs in line with your budget. So even though we're seeing a situation where treasury yields are now right on top of cap rates, which people don't like to see, in general, it usually signals, well, don't go buy real estate. Well, that's true in general if I wanted to go buy an investment property here in Santa Barbara, California. But if you have the financing in already, if you can conservatively pro forma that at a good rate, and one of the best avenues we have right now are cap rates for a while there had jumped up, not down. It actually jumped up pretty staggeringly during the banking crisis, and especially during the inflationary period. So it actually gives these communities the ability to now work back to their historic cap rate. So if something was a cap rate of, let's say, a 4.5, it jumped to 5.5% a few months ago. But knowing that you can get back to your, let's say you don't want to go back to 4.5, but want to go to 5, that's actually going to help your pro forma and your risk adjusted ability to get to your returns. So right now we have 76 units. It's under construction. Andrew will get into that. We're partnering with a great partner who's the largest full service real estate firm in the entire state of Wisconsin, Ogden and Company. This project is just a mile from downtown. We only need, I think, about another $500,000 here, 6.5 million in project equity. We have all of it, but just a little bit left. $18.6 million loan in place for construction and perm financing at 4.5%. And we're right on our project costs right now with a 12% return. Go ahead, Andrew, you want to talk a little bit about this project?
Yeah, dovetailing on that, the partnership that we have between the developer Ogden and the GC Peridot, it has just been really nice. It's a breath of fresh air. We were there 2 weeks ago, met with the team in person, walked the site. It was great to see. Right now, status-wise, we've got all the underground work completed for the most part, and we're going vertical with concrete. So that's walls, elevator shafts, and columns. So that's continuing, and we're scheduled for a Q4 of 2024 opening.
And then Avery, Fargo. Now these are all available. So we're just giving you kind of an advertisement of all of these. We don't want to do too deep of a dive because of our time commitment here today. Reach out to us. We can dive into all of this. We have a data room that you can go into. We have all the marketing materials associated with these ready to go, and look forward to getting them out to you. And then call us and we'll have meetings to talk about your investment, what you're looking for. We can dig a little bit deeper. Avery Apartments is our latest in Fargo, 168 market units. We're starting construction on this deal in February. Also 2,500 square feet of retail, which is really great for cash flow. We're working with Kilbourne Group, which is the #1 developer in the city of Fargo, and most definitely the downtown area. This is the most popular dining and business section of Fargo. Fargo is growing like crazy with Microsoft's second largest campus and all sorts of tech, and their population growth and all the different dynamics that I mentioned from a demographic standpoint earlier makes a lot of sense for our risk adjusted return modeling that we do. We have an in-place loan right now of $26.4 million on this project. I think we have this one at 6.16%. Total project cost at $37 million, and this has a 10% preferred return. Go ahead, Andrew.
From a construction development side, we should be seeing the final pricing from the general contractor by the end of this year. We'll get those contracts in place with a scheduled start in Q1 of 2024, with a scheduled completion approximately 24 months after that, so Q1 of 2026. And I will say something really unique about Fargo in this project in particular is that the city actually pays for the parking garage. So the project doesn't have to absorb that cost, as well as there's a large performing arts theater embedded within the project. So really a multifaceted project and a really nice small Fargo downtown. It's a great project.
Yeah, and I'll also add completion on this should be 2026. And we're already lining up potential perm financing on this particular project. So we're way ahead of the game as far as tying up all the loose ends here. And then we have Peyton Lofts is the last one I'll present to you. This is in Spokane, Washington. Spokane is just booming. Again, we look forward to talking to you about Spokane, and we'll also do specific webinars for each one of these projects as well. 96 units, multifamily, right downtown in a historic building. There's 16,500 square feet of retail that's fully leased on the bottom on leases for 10 years. So while we're building this deal or redeveloping this project, we'll have cash flow coming through all of these tenants as well. So our developer there is 4 Degrees, the largest. They've done most of the development in downtown and in the surrounding areas as well. Right downtown Spokane, it's right next to the multi-transit terminal. The most popular dining and business section, we're looking for 11.9 million in equity. We just opened this up, and we're already seeing a lot of indications of interest. And I think we took in our first 5 or 6 investments already. Here, $22.3 million loan in right now with the Bank of Idaho, and discussions with HUD about getting permanent financing in 2026. And this is at a 10% preferred return. Go ahead, Andrew, give us an update on where we are with this project.
Yep. So we should be seeing general contractor final pricing right around January of 2024. It's something unique about this property is that it's being converted from office to multifamily. And so as tenants have been leaving, the developer has been selectively demolishing those floors so we can see behind the walls, get a more accurate state of what the structure looks like, which really boils down to reducing risk. So we should be complete with this at the end of 2024. So Q4 2024 complete.
Right. Thank you. And so again, going over what Andrew just said, and I want to emphasize two things about Andrew's position. Go ahead and show your face, Andrew. What makes us unique too is we are a developer. We have our own development department. Andrew runs development and construction. We're not just a sponsor, but with a 10-year hold, it's imperative that we be involved in the construction, in the oversight, in the accountability. And so this is where Andrew really comes in on a day-to-day basis to look at each one of our projects and including doing due diligence on new projects to make sure that everything fits our criteria from a construction and development standpoint. And somebody who's representing you, the investor, meaning from USG, is constantly in contact, making sure that the projects are on target, doing what they're supposed to, and that all the codicils of the operating agreement are in play. And so everything we do is to protect our investors, to be a good partner to our developers, and to maximize the cash flow and values for our investors. So at the end of the day, we give the investors the choice of where they want to invest. And again, it's the only fund you'll find out there that does it this way. With that, we've had a bunch of questions that kind of came into me while we were talking. I'm going to open up the lines, and David, if we can get Michael back on to open it up for Q&A. And if you could tell us, David, how would our attendees be able to do some live Q&A with us right now?
If somebody has a question, want to go on air, you can raise your hand and we'll go ahead and elevate you up where we can hear you, or you can just type your question in the Q&A panel.
In the meantime,
the
while they're doing that, I'm going to read what I've got here. T. Darden, I'll go from top to bottom. T. Darden, hi. Assume someone has gains in an IRA or 401k and they need to distribute proceeds out due to death. Okay. Simply take distribution or simply to take the money out. Is there a way for an Oz investment to reduce this kind of tax? So number one, and I have to legally say this, we're not CPAs and we can't give tax advice. So this is not tax advice. I can only tell you what our opinion is and what we've seen. But if in the IRA, the 401k, let's say you had a Roth, if the taxes are already been taken out, then it wouldn't make any difference if you went opportunity zone. But when you've taken constructive receipt of actual gain that you owe taxes on, you can put it into a tax advantage investment. It doesn't have to be us. It doesn't have to be an opportunity zone. It could be other things, but anything that would mitigate taxes in the opportunity zone side, at least, yes, you can put it in there. It's a good thing for the government, and it's also a good thing for the investor. The government wants to see people putting money in the opportunity zone funds because now they know in 2026, at least right now, in 2027 rather, they're going to see that tax money. That's why they also want people selling stocks too. They want to see, when you look at the opportunity zone side, you can actually see what the taxes are going to be, and it actually is helpful for the government in that perspective. But it's great for the investor because they're deferring those capital gains tax during that entire period. And T. Darden, if you want to go a little deeper in this, ping me offline and I'll be happy to go a little bit deeper. T. Darden also asked, you mentioned selling an asset quickly in order to capture gains early in the fund. Actually, how does that affect the permanent deferral? Okay, actually, I didn't realize that's what I said. That wasn't what I meant to say. What I was saying is we can build smaller projects, we can build quicker, we can get to the refi quicker, we can get to the distributions quicker. That doesn't mean that we're going to sell it before the 10th year necessarily. It's about maximizing the value. However, since you brought up that question, maybe I should do this so you're not looking at our faces. Since you brought up that question, you have to look at these funds as who has the best ability to sell early if that occasion comes up. So the way the regs are written, if we sold a project in the 5th year, we got some ridiculous amount of money, a ridiculous offer, somebody wanted to pay it, and of course you want to take it and the investors want to take it. As long as we don't give you a constructive receipt of that money and then maybe redeploy it to another smaller project, another opportunity zone project, we can do that. Basically, you're 1031 exchanging it over. It's what it comes down to. That's a colloquialism as the way I'm using it. But we take the gains, you put it into the fund. The only negative there, it's great for the gain. The only negative is your clock's going to start over again on your 10 years. But it's something we bring to the investors and say, hey, we have this opportunity. Should we do it? This is the pros and this is the cons. But the real question is, if we had a big $200 million project and we got that offer, how are we going to move, let's say 400 million, if we got double the amount, how are we going to move 400 million to another opportunity zone fund and still be able to hit the mark? The way we do it, it's high, if there's better likelihood that we're going to be able to find another smaller project in the opportunity zone world, to be able to capture the gains, put that money into another project and still be able to hit the 10 years. Those are all things that we can't say we promise to do it or we guarantee it. What I am saying is the way we've structured our risk mitigating modeling is, if that should occur, we're in a better position than just about every fund out there to be able to move to other projects. That's the answer on that one. And then again, ping me offline if you need. And then Sandy Hefferman, hi. Q1 delivered by March 1st is aggressive to receive a K1 from a Q to complete the return. Usually don't get our K1s until early. Well, actually, if you get them early mid-March, that's actually pretty good from most. But Sandy, the reason we do it, it's always been a pet peeve of mine being in the partnership industry for 100 years. People tend to get their K1s way late, and it really it's a good investment, but it's screwing up your accounting or trying to get your taxes done. So in each one of our operating agreements, we have it written in that our developer partners have to have the tax returns done for each project. And I don't have the exact date, but I think it's February 1st. It's either the first or February 1st or first week of February. Then that goes over to Mosaic Financial Group, our fund auditing group, and our audit and accounting group to get the K1s out. And that's how we do it. The developers are contractually obligated to get us those returns by February so we can get them out in March. Okay. Another question. Eddie Chow, excuse me. May we have a we may have a replay of the presentation. Yes, Eddie, it'll take a few hours. Our digital marketing group will be taking this presentation, honing it a little bit, cutting it down from, better optics. And then we'll put it on our website at www.usgre.com. And we will also have it on our YouTube page after, so you can watch this at any time that you want. Khan Kamal, the construction costs and opportunity, the construction cost and opportunity zone, can that we claimed a loss and offset from our overall tax liability in 2026. I think what you're asking here is the loss and the offset, can that be offset anywhere else on your taxes in 2026? That's what I'm getting from that question. The answer is yes, but you have to take the first asset first, meaning if you receive money from us in, let's say, 2026 from a refi, and that's going to be tax-free money, by the way, anyway, so there's no taxes there, but it's about getting having enough money to pay the taxes that you would have owed in, let's say, 2022 or 23. If there's any carry forward or carry over, you can use those losses in your taxes. But honestly, the way these things are set out with losses and all that, you probably won't run into that until the 10th year. But again, contact me offline. And then I think this is a positive. I got a message here from Sandy saying, wow, with a smile. So that's good on getting those K1s out. Any other questions that we may have right now? Let's see, I've got to go to my how can people get online, David, and speak the question if they haven't?
They could raise their hand and we can elevate them to a microphone. They can ask a question out loud or just type it in the Q&A.
Okay, we'll wait a little bit. And while we're waiting, we'll start our wrap up. Please ask questions. We don't want to keep people on the line any longer than they need. I'll kick it off, and then we'll go to Andrew and then Michael. At the end of the day, when we do these webinars, and we do them every 3 months or so, I do have another question here. Our whole goal here, you can't in an hour try to go over all of this in such detail that you can make an investment decision. We're all about oversight, accountability, doing it right, risk modeling. We don't open up the floodgates and just let everybody just come in and then say you can't have the investment because we filled up all the equity. We work with our investors to place the money to make sure that it's what you like and what you want. We reserve the money aside so that you have some time to make a good decision with us or whoever you're making the decision with. And then at the end of the day, we want to prove up our risk mitigation modeling and how we do our oversight, where we get paid. We don't get paid a ton on these deals. We really don't make any money on the front end when you buy it. We do get a small 1% on equity, not on the value, but we do get a 1% asset management fee annually on the equity amount only. That's it in the middle. And then at the back end, once you've gotten your return of capital plus your preferred return, then we'll split with you 80-20. But again, our prefs are pretty high. So and then I think the only other area is we get a 3%, we get a 1% disposition fee, not 3. We get a 1% disposition fee. So if anybody out there wants to look at our grid that's been approved by our managing broker dealer, shows where we believe we make money and how it works, happy to send that to you. You don't see that a lot of times from sponsors. We're happy to say where we make our money, how we make our money, and why we make our money. And then at the end of the day, you have full choice of what it is you want to invest in. We try to make it easy, and we pride ourselves on protecting you and being a good asset manager for you. With that, I'm going to have Andrew give some last words.
Yeah, really just, my role here is to make sure that everybody feels comfortable. If there's questions, what I like to tout about USG is that when you call us, you're getting one of the 4 partners. You're not getting a call center. We are the ones answering it, depending on what the question is. Myself and Kim Hansen, who's the other founding partner, who's not on the call right now. But, we really tackle all the due diligence. So if there's any questions on that field, we're happy to carve out some time and answer anything you have. And then obviously, once we get into construction, you have a question, we're right here for you.
Michael, any last words of advice for us?
No, I think that was a great presentation. If you guys have any questions about, the market in general, I really set it in a neutral standpoint. So give me a shout. I see a lot of data on the back end. And as I said, I've been doing this for 5 years. So I see it, from multiple aspects, whether it's the investor, the fund manager, the distribution side, even the development side, right? So if you're looking for some neutral perspective, feel free to reach out to me, and I'm happy to provide that.
Thank you so much, Michael. And then I've got a couple questions here. Let me grab them real quick before we go. Oh, it was just Sandy Hefferman saying, nice work, guys. Oh, that was really nice of you, Sandy. Thank you so much.
Thank you, Sandy.
So before we go, one last thing. One, I hope we were able to present ourselves properly to you, and you got some really good information, not just on us, but on the Opportunity Zone world. We're going to know a lot more information November 1st, too, when I come back from DC. As far as the Extension Act is concerned, I'll make sure to disseminate that out to everybody. 3 is, if you have interest, please go to our website, fill out the form. It'll go directly to us, and then we'll get back to you. We'd really love the opportunity to earn your business and really show you, how we're unique. And especially during times like we have today, our model really makes a lot of sense. We've got a lot of political turmoil. We've got interest rates going up. We've got a stock market all over the place. Rebalancing portfolio makes a ton of sense right now, especially into real estate. And rebalancing into real estate with tax advantages really, really makes sense. And the question at the back end is, how do I do it? How do I do it safely? And how can I somewhat count on the likelihood of hitting the returns that these people are pushing out there as potential returns? How can I feel that that's being done on a risk mitigated level, plus the likelihood of being able to hit those returns? We're happy to have those conversations with you and work with you. So please ping us directly, go to our website. You can see a lot of information about our projects and how we do things. You can also contact us directly through the submission form. And then lastly, the recording will be available. I would say, I'll just say it'll probably be today, but I'll just tell everybody, let's say by tomorrow morning on our YouTube page, as well as our website. With that, I want to thank David for producing today's presentation. I want to thank Michael for being on the presentation. I want to thank Andrew for doing the same, but mostly I want to thank all 68 people that ended up coming on today. That was really a lot, which that's great. I want to thank everybody for having the desire to listen and hopefully learn a lot about us, or at least enough to want to push forward. And just can't thank you enough. So I got another message here. Put my contact information up. Oh, okay.
Yeah, I got it, Greg.
Well, here, I'll do it real quick. Sorry, guys. So for those that are still on, there's our contact info. All you have to do is put your QRF up there. It'll go right to our website, and we'll get back to that ASAP today. Okay. Thank you, David. Thank you, Michael. Thank you, Andrew.
Thanks, all.
Thank you, all the participants. Really appreciate it. And for those investors I saw that were on here, thank you for your trust, and we really appreciate you giving us the honor of managing your assets. We really do, and we take that very, very seriously, and I hope others will give us that opportunity as well. Thank you so much, everybody, and have a wonderful Wednesday.